to record this webinar, so it will be available for you to view or share. So again, welcome today to our Mid-Atlantic Housing Market Update. My name is Lisa Sturtevant. I am the Chief Economist here at Bright MLS, and we get together monthly for these webinars to talk a little bit about where the economy and the housing market are going, maybe what to look forward to as we head into the rest of the year. I see that there is someone who's commenting they can't hear. If that's a problem other folks are having, if you wouldn't mind putting that in the chat, that would be great. I wonder if those of you out there are having the same sort of concerns many of us are, in that we sort of hear a lot about what's going on in the housing market, in the economy. There's actually some conflicting information out there. And I really think now more than ever, it's really important for all of us to have as much information as we can, but also to kind of understand what the most important things are to be watching, because there's a lot of noise out there. There's a lot of information. And so hopefully taking this time today to do a little update on where we are in the housing market here, and what are some of the key trends that I'm looking at. So let's get started. You know, I do want to just start a little bit at taking a look at the economic picture. There are a lot of positive economic indicators out there. There's some that seem less positive, and that makes for a really tricky time trying to understand where we are in the overall economy. And so, sorry, I was just checking the Q&A and the chat, but why don't I keep going and then I'll come back to the chat and the Q&A. As we look at the overall economy, you know, one thing we've seen is that over the last 2 quarters, the overall economy, as measured by gross domestic product, has risen by about 3%. Those are those 2 bars over on the far right-hand corner. Those bars indicate that the economy is growing. It's growing at a pretty healthy rate, and it follows 2 quarters of really slower than expected GDP growth. One thing, though, is that the housing sector continues to be a drag on the overall economy. The blue bars in this chart are residential fixed investment, basically the housing component of the overall economy. Housing accounts for between 15 and 20% of the overall economy, depending on the year. And you can see the boon housing brought to GDP back in the 3rd quarter of 2020, 4th quarter of 2020. But recently, as the housing market has slowed, as new construction has slowed, we've seen that the residential fixed investment piece of the economy is actually down year over year. And if this segment of the economy, if home sales activity, if new housing construction, new leasing activity, if all of that begins to increase again, we will start to see that show up in these overall economic measures. And I think there's reasons to think that the housing market has sort of bottomed out, and then we are poised for greater activity in the spring as we head into the spring home buying market. You know, one thing we've seen is that the labor market has been surprisingly resilient over the last, couple of years. You can see that in the middle of 2020, when the pandemic hit, unemployment rates in the US in gray, and then in our 3 metro areas, Philly, Baltimore, and DC, really spiked. But since then we've come down, and we are now at, unemployment rates at decades low. The labor market remains really tight. And jobs are still being added to the economy. And all of that resilience in the labor market really comes even as the Federal Reserve has been taking very aggressive action and raising the federal funds rate. So you can see the solid line here is inflation. The dashed line is that short-term federal funds rate that we have heard the Federal Reserve raising now 8 times in the last 12 months. The idea of raising the short-term federal funds rate is it means it makes the cost of borrowing increase. So it would make consumers and businesses spend less. And that would then bring inflation down. And the risk when the Federal Reserve targets short-term interest rates is that businesses will not only slow down their spending, they will also pull back on hiring, and they'll reduce payrolls, and the labor market could suffer. and then the economy could go into a recession. And we actually haven't seen that happen so far. The labor market is holding really firm. What we have seen, of course, is that as the Federal Reserve has been raising the short-term interest rates, mortgage rates, these longer-term rates for borrowing, have really increased quite quickly. Mortgage rates are around 6.5% right now for a 30-year fixed. Historically, if you look over the last few decades, a 6% mortgage rate is not particularly high. It's pretty typical. But what has been really unusual, or what was really unusual, was how fast mortgage rates increased, nearly more than doubling over 12 months. And you can see in the table here in the Mid-Atlantic market, the median price of a home, let's say in December, was up a little bit less than 1% compared to a year earlier. But because mortgage rates more than doubled, the typical monthly payment that a home buyer would face is now more than $600 more than it was a year ago, an increase of 44%. And that is, the primary reason why we saw this pullback in housing market activity, as the cost of buying a home has increased, not just because home prices have risen, but because mortgage rates have risen so quickly. And there's been a lot of very fast movement in the housing market, a little bit of whiplash in the market as we go from the first half of 2022, which was really fast paced, to the second half, where in December, for example, we saw slower housing market activity than we'd seen in more than 2 decades. And so the question, of course, is, what should we expect as we move into 2023? We're going to be moving into 2023, as I said, from a period of pretty low home sales activity. So on this chart, we have the number of monthly home sales across the Mid-Atlantic, covered by the Bright MLS. And you can see 2022 is that line in dark orange, and then prior years, 2021 in dark blue, 2020 in the lighter blue, and so on. 2022, the orange line, you can see monthly home sales were running pretty briskly in the first half of the year. Mortgage rates began to rise, and then the number of monthly sales fell quite quickly. In January, we're seeing that the number of sales in January 2023 was actually down again 33% compared to where we were a year ago, really reflecting this sort of slowdown in buyer activity in the late fall and through the end of last year. Home sales activity is down 34 or 36% in all of our major metros across the region. Despite the slowdown in home sales, we continue to see pretty firm prices in the greater Mid-Atlantic region. Home prices were just up very modestly in December, but you can see from the last few years that home prices have been rising by 6, 8, 10, maybe even 14% year over year. And if you look back to 2020 to 2018, home prices in the Mid-Atlantic are still 35% higher than they were just in 2018. And so as we're going to hear talk of, prices softening, of the market cooling a bit. And there are going to be some markets where we'll see prices come down from where they were last year. We will still be far above where we were before the pandemic hit. And it's important as you're working with, let's say, prospective buyers who might be worried that they buy a home now and find that the prices of homes falls. Really, that's the wrong time horizon, of course, for a prospective buyer to be looking at. And we've seen very strong price growth over the last 4 or 5 years. And that is what we anticipate here in looking in the years ahead. This just shows where prices in the Philadelphia, Baltimore, and Washington area housing markets have been since 2019. In January, we saw across the Mid-Atlantic that the median home price was up 4.5% year over year. That's where a typical annual price appreciation would be. And we can see prices were up even more in the Philadelphia market. Median price up 3.8% in the Baltimore metro area. And in the Washington area, after a December where we saw a year over year price decline, prices were firm in January. Home prices, of course, the median price a little bit higher in the Washington metropolitan area. Affordability, a greater concern in the Washington region, but still seeing prices hold firm. year over year. Home prices have fallen from peak. And what I mean by that is if you look back to the highest median sales price in the region, those are typically summer prices. And since then, the monthly median home price in all of our markets has come down. That's true. What is also true is every year we see home prices fall from their summer peaks as we head into the latter half of the year. In this case, this year, we're seeing that peak to December decline a little bit steeper than we would in a typical market. But it does reflect some of the seasonality in the housing market, and maybe I think being a little bit overplayed in the media that there's this decline in home prices for the peak, when, as I mentioned, that is a typical seasonal pattern in the market. We didn't have that same pattern in 2020 and 2021 since it was such an unusually busy housing market. But if you go back to 2018, 2019, you do see in December, median prices are down from where they were in the summer. But there is some room for more price adjustment, and we'll talk a little bit more about that. What we're seeing in this very unusual market is that it's not just home buyers who are sitting out or sitting on the sidelines at the end of 2022. But it's also sellers. And you can see that reflected in some of this data. So the chart again shows monthly new pending sales every month. And you can see the orange line is 2022. New pending sales were tracking at about where we were in 2021 and in 2020. When you look at what happens over time, you can see that the pace of new pending sales activity fell from that track, and we're hit actually lower levels than we'd seen really in more than a decade. We're starting to see a little bit of traction on the buyer side with more buyers coming back in the market in January, but still the number of new pending sales in January is still down 18.7% compared to where we were a year ago. You look at the Philadelphia metro and the Baltimore and the Washington regions. January 2023, new pending sales down compared to where we were last year. And importantly, and what I think is where we should be doing our comparisons maybe moving forward is we're even down compared to where we were in 2019, which we might think of as more of a typical housing market. So I think that we'll start to see these numbers begin to move a little bit in February and March. But I do think that we have seen the bottom of our housing market, and we're beginning to see an uptick in that buyer activity when we take a look at some of the weekly January data. But as I mentioned, it's not just buyers who are sort of sitting it out during the fall and into the winter. And we know buyers, were sort of sitting on the sidelines as mortgage rates passed 7%. And then sort of the numbers weren't working for some folks who were out there looking for financing. And then I'll be honest with you, I think a lot of people just said, you know what, it's almost Thanksgiving, let's get through the holidays, and then sort of regroup and come back into the housing market after the first of the year. Because as we saw mortgage rates tick up a little bit in January, tick down a little bit in January, we did see some buyers come back. But it wasn't just the buyers, right? And we have to remember that, most sellers are also home buyers. And so as we saw buyers pull back from the market, we also saw sellers pull back. The number of new listings that were coming onto the market each month hit a 2-decade low in December of 2022. So both sides of the housing market equation are shrinking, meaning that there are fewer buyers out there in the market right now. But those who are still finding very low inventory and may even be finding the market very competitive since the number of new listings is just quite low. We can see compared to a year ago, the number of new listings in January is still below where we were in 2020 and still far below where we were in 2019. And that suggests to me that as the market rebounds, we're seeing demand begin to come back before supply. And I think that we will have experience where buyers who are in the market will continue to find inventory pretty tight. One measure of how buyers and sellers are kind of resetting expectations are in terms of how pricing has been changing. You know, you can see here that the average sold to list price ratio was above 100 throughout 2021 and into 2022. That meant on average homes were selling for, 2, 3, 4, 5% more than asking price. As you guys know, there were multiple offers sometimes 10 or hundreds of thousands of dollars over list price. What has happened when mortgage rates rose is we can see a sharp downturn in that sold to list price ratio, and we're back down to around 97%, meaning the typical home sells for about 97% of what it was listed for. That's more in the ballpark of a typical housing market. And it suggests as the housing market is resetting that buyers have more leverage, there's more negotiation during the transaction, and that's something that that sellers really should be expecting as we head into 2023. There's a question about the data with new active listings enter monthly in 2018 or 19 and 2022, and how many went into contract. So I think this question is about sort of the velocity in the market, right? So how fast are homes that are listed coming into the market? And if you are a subscriber to Smart Charts, smartcharts.com, which is a tool that uses the Bright MLS data in order to create all sorts of different ways to look at the data, that success rate is one of the metrics that's measured there. I don't have a measure in this presentation, but I'm going to make a note because I think that's really important for us to track, is how how often active listings are going under contract and how quickly. And as you rightly point out, might be a more relevant measure of this current housing market. One thing we have been tracking, though, and that is a pretty dramatic change in the market, is that back before the pandemic, more than, around 50% of transactions had some type of seller concession, usually help with closing costs. That number dipped down to about 20 or 25% of transactions. And we're starting to see that on the rise, which is another indication that buyers are asking for more concessions, and sellers are finding that they're having to negotiate a little bit more than they might have had to over the last couple of years. The number of active listings in the market has been rising slightly, but it's still pretty low. The orange line, again, is the number of active listings at the end of the month. And you can see how that compares to 2020 to 2021. We're slightly above 2020. We can see inventory is up pretty significantly from last year at this time, up 42%. But look, we're still at less than half the level of inventory that we were even just 3 or 4 years ago. And there are lots of reasons, including some demographic reasons, as people are remaining in their homes longer, as new construction has not been able to ramp up to keep pace with demand, that we expect that inventory will continue to be relatively low, really this year. And I hate to say for the next 3 or 5 years, we will probably find ourselves in still a relatively low inventory environment where buyers will still need to be ready to act, ready to make a move when they find a home that they want to buy. We are seeing, though, that buyers are taking a little bit more time, being a little bit more deliberate, and maybe having a little bit more space to be deliberate in the market. The median days on market has been rising. If you see, again, that orange line, it has been rising from where we were earlier in 2022. We are up 10 days compared to where we were last year at this time, meaning homes are taking typically 10 days longer to go under contract than they did a year ago at this time, last January. But look, compared to 2018, 2019, homes are still moving very quickly, and there is still relatively high levels of concentration in the market, high levels of competition in the market as inventory remains pretty low. There's a lot of good questions coming through the chat and the Q&A, so I apologize. I keep looking up to see, make sure that I'm addressing any that are coming through. So just to recap, the second half of 2022 was really very different than the first half of 2022. We saw both the number of new listings and the number of new purchase contracts fall to levels we haven't seen in 2 decades. We are starting to see a rebound in housing market activity as buyers who had been sitting on the sidelines for the last few months are really eager to get back into the market. And as we think about this market we're headed into in 2023, it's really important to remind ourselves, our buyers and sellers, that 2023 is not 2008, right? So the last time we talked about a housing market slowdown or a housing market contraction was back in 2008 after years and years of very fast price appreciation. And as you know, back in 2008, home prices fell by 30–40% in some local markets. We're in a very different situation this year. Very low inventory compared to where we were 15 years ago when there was a lot of new construction, where inventory was rising. In our case, we still have inventory very low. There's virtually no subprime lending in the market, where that was rampant during the last housing market boom. The foreclosure rate is very low. Back in 2008, there was a flood of foreclosures coming onto the market, which really drove prices down. You may see media headlines that says the foreclosure rate has doubled. I would urge you to read, dig deep into those kinds of articles. The foreclosure rate has indeed doubled from a year ago, but a year ago it was 0. And so now it's a little bit higher than 0. And we are still seeing a foreclosure rate far below what is in a typical housing market. We have relatively strong labor market conditions. And while prices were rising really quickly over the last few years, look, we had 1 year back in the last boom where the median price was up 50% or more. And so this rapid price appreciation that we've seen is really much different than what we saw back in 2004, 2005. So if we look ahead a little bit, we can talk about where 2023 might land. And so we do forecasts of the housing market and looking at transactions. The forecast for 2023 is in that column there, labeled 2023. And the forecast is for, at the national level, for there to be about 4.865 million home sales. This will be the first time there's been fewer than 5 million home sales US wide since 2014. And you're saying, Lisa, you made it sound like the market was so positive. Why are we seeing such few transactions in 2023? Well, look at 2021, right? So we had many people who might have been in the market in 2023 actually move their home purchase up a little bit. So more than 6.1 million home sales in 2021. As the pendulum swings one way, it has to come back the other way as we sort of write ourselves into a more typical housing market. And we will see a similar pattern across the Mid-Atlantic, as well as in our 3 major metro areas, where the number of transactions in 2023 will be lower than they were in 2022. Not only because people pushed their home purchase earlier, but also, unfortunately for buyers, we're going to be talking about how inventory continues to be a constraint on the market. And there would be more home sales if there was more inventory. But as I mentioned, there's reasons to believe this inventory shortage is going to be with us for the near term, really over the next 2, 3, 5 years. And that will limit the number of transactions. But home buyers and home sellers are really starting to begin to accept this new normal of mortgage rates being around 6 or 6.5%, of buyers and sellers needing to come to the table to negotiate. And frankly, the transactions is taking a little bit longer than it was taking back in 2020, 2021. When we look at home prices, you can see that for 2023, the projections are for home prices to be pretty flat, right? In our region, up by 1% or so. And there are I have spent a lot of time thinking about reasons why home prices in our market would fall, right? Because there's a lot of talk out there about how home prices are going to really come down. And while there are some markets across the country, some high cost markets like Los Angeles, some really fast paced markets like Austin, where we will expect home prices to fall, in our market, there are just too many prospective buyers in the market for too few homes to be able to understand how home prices could possibly come down. Now, as I mentioned, and we saw, prices have fallen from their peak levels, but on a year-over-year basis, we're expecting that home prices are going to be pretty stable here in the Philadelphia, Baltimore, and Washington metro areas. You know, there are some parts of our region where there's a greater risk of price declines, and if you've joined me for any of these webinars in the past, you've seen this map before. But again, it just is testament to the fact that all housing markets have always been local. But now, as the housing market is resetting, it's more important than ever to be paying attention to very local market conditions. Some of the ex-urban communities, for example, you can see down in North Central Virginia, Fauquier County, Warren County, down there in Rappahannock County. These were some of those so-called Zoom towns that attracted really significant demand during the pandemic, but have really seen a pullback in buyers in this DC metro area. And those home prices are really resetting to reflect local economic conditions. We're seeing a similar pattern in some of our coastal communities where there was a big surge in second home purchasing during the pandemic. And now we're seeing inventory in some of those local markets really start to rise quite quickly. And it's a possibility then that we could see home prices come down year over year in, let's say, Sussex County, Delaware, particularly on the beaches, Worcester County, Ocean City, Maryland, and even some of the Eastern Shore communities along the bay. But look at the major metros. If you are in one of those, you can see, DC moving up 95 to Baltimore and up 95 to Philadelphia, relatively stable, relatively low risk of price declines in those local markets. And so if you put this all together, what does this all mean for buyers? Buyers should expect that mortgage rates will remain kind of in the 6 to 6.5% range. We saw a very strong jobs report in January. We saw a worse than expected inflation report, meaning inflation didn't come down as fast as folks had hoped. That means the Federal Reserve is going to continue raising the federal funds rate. Some of that is already baked into mortgage rates, but it could move mortgage rates a little bit higher over the coming weeks. But I'm expecting they'll still stay around 6.5%, not going back up to that 7% we saw back in the fall. More than ever, rates and terms are really going to vary across lenders, so buyers should be encouraged to shop their mortgage to get the one that works best for them. Buyers will still find a lot of competition in the market, but they should have more leverage on price and concessions. I'm thinking there'll be less competition from investors and cash buyers, but on the other hand, if rates remain elevated, we do know that cash buyers do tend to move into a market when they can compete and not have to look for financing. The investor share of our market tends to be pretty small. It is really first-time home buyers competing with repeat buyers that creates the biggest challenges. Repeat buyers have the ability to sort of roll over record levels of equity into their home purchase, making it easy for them sort of to pay to buy down that mortgage rate a little bit. Whereas first-time home buyers who frankly have had a really challenging market over the last few years are still going to find the market pretty difficult. And first-time buyers and repeat buyers alike need to really still be prepared to make an offer when they find a home that they're interested in. On the seller side, I think there's been so much talk about, slowdown in buyer activity that sellers might think, well, I'm not going to be able to find anyone to buy my home. Why would I list it now? And I really think that's a misconception, and that we should expect an uptick in buyer traffic. Pricing, though, is so important. Sellers need to set their list price reflecting current market conditions, not what they hope to get or what they saw their neighbor get a year ago. It is back to having to prep that home for sale, getting it ready to show and to be prepared for the buyer to come to negotiate on price and concessions, and to ask for things like closing costs as part of the deal. Sellers are still getting multiple offers in some cases, but like I said, the buyers are often bringing more requests to the table as they have more leverage this year. And then lastly, I think for agents and brokers, I do think this is an opportunity for real estate professionals to demonstrate their value to the transaction, help dispel myths that we might be seeing. A lot of the media coverage of the housing market is sort of about the national housing market, which, as you know, there is no national housing market, and conditions in, let's say, Los Angeles or Miami or even New York are very different than what we are seeing in our market. And you can really be a resource on local market conditions to help re-educate, frankly, buyers and sellers who may have only been in the market for the last 2 years and think that's sort of what normal is. Even, frankly, some real estate professionals who have only been working in the business for the last couple of years to try and re-educate everyone involved in what a more sort of typical housing market should look like. Median days on market, sort of 30, 35. Home prices, at about 97% of what list price is. And half the time or more, sellers are offering some type of seller concession to buyers to close the deal. I'm going to take a look at the Q&A here in just a moment, but I want to make sure that you're aware of all the resources available on brightmls.com/research. We have weekly market reports, monthly reports. If you like your reports in infographic form, we have them in infographics. If you like videos, we have videos. We have these webinars the third Thursday of every month. We have a series of blogs on different topics related to the housing market, including migration and demographics, a lot of top 10 blogs to see if your local community made a top 10 list in terms of some housing market metric. And then our Bright T3 Home Demand Index allows you to take a deep dive at the zip code level into what's going on sort of before the contract is signed. We have an index that reflects pre-sales activity like showings and views of homes that allows you to get a forward look at where the housing market might be headed. If there's anything you're ever looking for and you think we might be able to help provide you data or research, please don't hesitate to reach out. My email address is there. I do really enjoy hearing from realtors and brokers and folks working out there with buyers and sellers, because you guys are the ones with your boots on the ground, as it were, working with people. And so I'm going to go through the questions that we have here. A couple of questions about whether the slides will be shared. And yes, the slides will be available along with the video of this webinar. Melissa pointed out that she's still seeing multiple offers in Sussex County, Delaware, and I've been hearing the same in many local markets across the Mid-Atlantic. And I think that is maybe a little bit at odds, right, with what some folks might be hearing in the media where we're hearing about a slowdown. But in our market, I do think that it's been maybe a surprising bump in January to see so much competition. There was a comment from Gil about new home construction prices continue to increase greater than inflation rates. With that in mind, won't this continue to directly impact the appreciation rates of existing homes, which will outpass your predicted appreciation rate? Good question. And that is such a local, it'll be a local market condition. Sussex County, Delaware is actually a good example where new home construction is still going pretty strong. And as you rightly point out, we haven't seen builders drop their prices. I think they learned a lot from the last housing market downturn, and they're a little reticent to cut prices. So instead, we're seeing builders offering upgrades or helping with buying down mortgage rates or other types of incentives that don't necessarily hit that price point, because when the market rebounds, they want to be able to kind of continue offering homes for sale at that elevated price. New home sales in most local markets are a very, very small part of the market. And to the extent that they compete with existing homes, for sure, we'll start to see that competition show up in prices across the board. And sort of Chester County, Shanta's pointing out that Chester County also is seeing multiple offers from a standpoint of a competitive market. And again, I think that's what we're seeing in so many different places. So there's a question about thinking about price. Mortgage rates have gone over 100%. Mortgage rates have increased by more than 100%. Prices are not going down. How will people afford this with inflation? Paychecks have not gone up lately, so it's not making sense. But that's a great question. And we've actually seen that wages have in fact gone up faster than they have in decades. For some segments of the population, wages have been increasing faster than inflation. For many people, though, pay has been increasing, but not as much as inflation. And so you ask a really good question. Why aren't prices falling more if mortgage rates have gone up, have doubled? And I think I've struggled with that as well. And what I think we're seeing is the fact that while mortgage rates are higher and prices have risen, existing homeowners are holding on to record levels of housing equity. And so a repeat buyer has more equity than ever before to turn around and put into the purchase of a new home. And so while their pay might not have gone up as much and they're facing a higher mortgage rate, they're able to put a lot more down than someone was 3, 4, 5, 10 years ago. And I think that's one reason why we haven't seen prices soften as much as we might have think so. There's another comment from Bobby about judicial foreclosures are going very slowly, but they are I don't know what that question is, which have significantly gone up. I don't know what data you're looking at. The foreclosure data I track suggests there has been an uptick in both delinquency and foreclosure rates, but that uptick is from a very, very low level. And it depends on the local market, but over the general market, we have been seeing a very relatively low foreclosure rate. A typical foreclosure rate is about 1 or 2% of loans in a foreclosure process, and we are still at the national level at about 0.9%, so we're down below that typical long-term average. Those are really great questions, and I think those are the things that we're interested in hearing from you so that we can know what to track. There's a last comment about seeing a lot of cash offers, and that's one of the things I'm interested in tracking more. So stay tuned for some more information coming out of us on cash offers. In the Bright MLS footprint, about a quarter of home sales in January were all cash offers. And I thought, oh, okay, that's interesting. Last year, only 20% of January sales were all cash. So this year, there is a greater share of cash offers in the market. So stay tuned, because I'm going to dig into a little bit on where those cash offers are and how that might be affecting local market conditions. Whew, that was really, those are really great questions, and I really can't thank you enough. And I'm going to stop my share now and thank you again for joining us. Please do check out brightmls.com/research, where you can find the PowerPoint presentation and this recording. Reach out if you have further questions, and I will see you guys next month. Take care.